Hello, Internet friend. Today on Value Side, the macro outlook for 2025, 3 areas of concern. I'm David Ravel. Well, in 2024, the overall economy took a negative turn in 3 areas critical for investors: corporate profits, the country's financial condition, and retail sales. Although each sector remained positive, it has taken on a decidedly negative direction. I'll be utilizing the data from the Bureau of Economic Analysis. The decline in earnings momentum. If there's one indicator that investors ought to focus on, it's corporate profits, known to investors as earnings. From a fundamental perspective, earnings drive the share price. In a positive economic cycle, the rise in earnings powers a bull market, such as we've experienced in the last couple of years. Now, suppose you've been listening to Wall Street's recent market projections for 2025. In that case, corporate earnings are always at the very top of the indicators they point to as signaling yet another stellar year for stocks. And corporate earnings in 2024 indeed hit another record high. That's a very good thing. However, what most have missed is that earnings have lost their momentum. In fact, the percentage change in corporate earnings turned slightly negative in Q3 2024, the latest data that we have. So while earnings remained positive, the rate of increase has slowed dramatically. As we delve even more closely into the data, we'll notice that in 2 of the 3 reported quarters, corporates had negative growth in earnings, a situation where the costs exceeded income. This could be due to many factors such as supply chain issues, out-of-balance inventories, or poor sales. But whatever the reason, corporate earnings are not as robust as Wall Street and many investors suppose. Adding to the market's perspective to our discussion, note that the recent behavior of the S&P 500, Wall Street has entirely ignored this loss in earnings momentum. This is mainly due to the sterling performance of those large-cap Magnificent Seven stocks, including companies like Google Alphabet, Microsoft, Apple Computer, and of course, NVIDIA. While investors may wish that these 7 stocks comprise the entire market, unfortunately, that's not the case. What's more, if history is any guide, these top 7 are as vulnerable to any market downturn as the rest of the market. Look at the behavior of companies like RCA and the railroads, the darlings back in that era, in the crash of 1929. They all fell along with the rest of the market. Now, the other reason the market seems to have ignored the decline in earnings momentum is that the confidence that the Federal Reserve will manage the economy so as to avoid any bad times. This perception is that the Fed got us out of the COVID-19 crisis and will do so again. The current financial conditions. Remember back to the COVID-19 crisis? It was a miserable time for all of us and especially traumatic for the economy. Non-essential so-called businesses were closed. Workers were urged to remain at home, social distancing became the norm, and the economic impact was profound. That dreadful second quarter of 2020 saw the worst economic performance in history. Annualized, our nation's GDP fell by a devastating 30%, worse than the Great Depression, although the Great Depression continued its decline for a much longer period. Now, for the Federal Reserve, it was all hands on deck, as new and untested strategies and techniques were used to bring the country out of this economic tailspin. Many highly technical tactics to keep the banks afloat were implemented, which we won't have time, unfortunately, to discuss here. But there were 2 principal strategies that the Fed used that we all saw and we all benefited from. The first Fed strategy was to reduce interest rates to essentially zero. The Fed had tried to raise interest rates to a more normal level for the prior 4 years, but the COVID crisis caused them to return to a ZIRP, a zero interest rate policy. Unfortunately for most of my friends in the investment world, that's as far as their memories go. Fed interest rate policy. So almost all the discussions today focus on interest rates. If the Fed just eases interest rates, then everything will be just fine, goes their thinking. What's more, with the Fed's latest rate cuts, financial conditions must be positive, and there's nothing to worry about from a financial point of view. But not so fast. Remember, the Fed utilized another primary strategy to get us out of the COVID-19 hole. Economists called it quantitative easing, but you and I remember it as those wonderful stimulus checks that showed up in our bank accounts. It seemed like money from heaven. But it wasn't from heaven at all. It was a significant strategy of the Fed. The mechanics behind all this were pretty straightforward. The Fed bought a ton of U.S. Treasury securities. And by ton, I mean nearly $5 trillion worth of U.S. Treasury bond notes and bills, which now reside on the Fed's balance sheet. Their thinking was that by putting that money into the financial system, they would start a positive cycle where banks would be anxious to lend out those funds, and people once again would spend. Putting money into the economy when times were tough, they have to now take it back after the economy recovered. Now, the stimulus part of this strategy ended in Q2 of 2022. That was the last time the Fed added funds to the economy. Since then, the Fed has been systematically withdrawing money. Mechanically, they've been selling those bonds, retiring them, and taking money from the purchaser, the big banks and brokers who make up the primary dealers. In the 2.5 years since the Fed went from quantitative easing to quantitative tightening, although the Fed won't use that term, they've removed roughly $2 trillion from the economy, not an inconsequential number. Combined, the Fed's due bill of roughly $1 trillion each year, with the interest on our national debt of another $1 trillion, and you see how 7% of our country's GDP is currently being used for debt service. Before an American factory can make the latest widget, or a consumer can purchase the newest gadget, our nation's interest has to be paid. At least $2 trillion comes out, theoretically anyway, of the country's income, its GDI. This is about as far from an easy financial environment as I can imagine, and it's being ignored by Wall Street, which must feel that these interest payments won't apply to their magnificent stocks. The resilient consumer. The one real bright spot in the economy has been the resilience of the American consumer. Through thick and thin, Americans continue to purchase at a rate that makes the economy hum. You no doubt heard about the 2/3 of all economic activity is being generated by the consumer. Consumerism is the engine that powers our economy. But recently, times have gotten tough for the average consumer. The worst inflation in a couple of generations means that it takes more to provide the same standard of living as 4 or 5 years ago. Today, prices are higher across the board, especially in such necessities as food, shelter, and energy. Many have met these escalating costs by increasing purchasing on credit. In the summer of 2023, we surmounted the $1 trillion level in revolving debt, that's credit cards and lines of credit, for the very first time. That's not a good trend, but it's been made much worse by the dramatic rise in consumer credit costs, which include both interest and fees. Although we don't have the data on credit card fees, we do know that the average interest rate charged on credit cards from major banks is up by nearly 50%, from 14.5% to 21.5%, adding an additional burden to consumers. But it doesn't stop there. As we noted in a recent article, it's the specialty cards, cards with enticing initial low interest rates, store cards, and affinity cards, where you find the staggering interest charges. It's not unusual to find a card that charges more than 30% in these special credit card interests. Although, as we noted, for now, the American consumer is extremely resilient, able to meet today's financial challenges and still provide their family with a stable lifestyle. However, subtle cracks are beginning to appear. Recently, charge-off rates for the major banks began to rise. A charge-off is when a creditor has been unable to pay their bill and the bank has been unable to collect, so the bank charges off any remaining balance. It's the final step of a long, drawn-out process that often involves bankruptcy for the borrower. In Q2 2024, the charge-off rates for the major banks reached 4.75%, the highest level in 13 years. Conclusion. Consider this the rest of the story, as Paul Harvey used to say, to the often overly optimistic projections we hear from Wall Street. While 2025 may be the third sparkling year in a row for investors, it will not come without some challenges. Our nation faces some difficult choices regarding our personal and national finances. Without a doubt, the country's balance sheet needs to be reined in. Like a consumer in a structured recovery program, we must find a way to lower expenses or to raise income. Hopefully, we can do both. While this is certainly not the end of the world as we know it, it is also not the overly optimistic future that some have envisioned. Hopefully, we can have a realistic view of 2025, one that includes both our challenges and our opportunities. And that's today's Value Side. For all of our articles, references, and podcasts, visit valueside.com. I'm David Ravel. ValueSide is independently written and researched. The views expressed are strictly my own.